It's happening. The liquidity freeze that will collapse stocks and send silver to $500, they just pulled the trigger Friday afternoon, 4:47 p.m. Eastern. While you were finishing your work week, the Federal Reserve made a move that Wall Street is now calling the Great Liquidity Extraction. Within 72 hours, every major bank in America will be forced to choose. Do they save the stock market or do they save themselves? They cannot do both. And the asset they're all running toward in absolute panic is not gold, it's not Bitcoin. It's the one metal that has been systematically suppressed for decades. And the math behind what's about to happen will make $500 silver look conservative. Welcome back to Currency Archive, the only channel where we treat your financial decisions with the seriousness they deserve. If you've built wealth over decades, if you understand that real knowledge isn't entertainment, then do me a favor, hit that subscribe button. Not because I'm asking for likes, but because the information we're about to share doesn't show up on CNBC. And before we dive in, drop a comment below and tell me, where are you watching from today? New York, London, Singapore? Let's see how global this audience really is. Now, let's talk about what just happened. The warning signs appeared on Friday afternoon, January 23rd, 2026, at exactly 3:47 p.m. Eastern Standard Time. While most Americans were wrapping up their work week, a small group of analysts at the Federal Reserve Bank of New York noticed something that made their blood run cold. The overnight reverse repurchase facility, the financial system's emergency pressure valve, had just recorded its largest single-day withdrawal in history. $483 billion vanished from the system in less than 6 hours. This was not normal market behavior. This was panic. The reverse repo facility is where banks park their excess cash overnight when they cannot find safe investments. When banks pull money out of this facility, it means they desperately need cash immediately. They are not looking for profit, they are looking for survival. And on that Friday afternoon, every major bank in America was pulling cash out like passengers grabbing life jackets on a sinking ship. But the general public heard nothing about this. The evening news talked about sports, social media discussed celebrity gossip. Meanwhile, risk managers at Goldman Sachs, JP Morgan, and Bank of America were working through the weekend, running emergency stress tests on their portfolios. They were asking themselves one terrifying question: what happens when the liquidity runs out? To understand why this matters, one must understand how modern markets actually function. The financial system today is not driven by human beings making careful decisions. It is driven by algorithms, massive computer programs that buy and sell billions of dollars worth of assets every single second. These algorithms make decisions based on data. They need specific numbers to function properly. They need the consumer price index to measure inflation. They need employment reports to measure economic strength. They need treasury yield curves to measure risk. These data points are the oxygen that keeps the algorithmic trading system alive. Without them, the machines cannot calculate risk. Without risk calculations, the machines cannot trade. Without trading, markets freeze. And here is where the nightmare scenario begins. The United States government is now 6 days away from a complete shutdown. This is not political theater. This is not a negotiating tactic. President Trump's statement on Sunday evening made the situation brutally clear. No budget deal is coming. When the government shuts down, the Bureau of Labor Statistics stops publishing employment data. The Commerce Department stops releasing GDP figures. The Treasury Department stops updating debt statistics. The data flow stops completely. Wall Street has seen government shutdowns before. In 2018, the shutdown lasted 35 days. Markets barely noticed. But 2018 was a different world. In 2018, national debt stood at $20 trillion. Inflation was running at a comfortable 2%. Global trade was stable. Central banks had room to maneuver. 2026 is fundamentally different. The national debt now exceeds $40 trillion. Inflation is running hot, despite official claims of stability. Geopolitical tensions have disrupted supply chains across 3 continents. And most critically, interest rates are already at levels where central banks have almost no ammunition left to fight a crisis. The algorithms that run the markets are designed for normal conditions. They are programmed to handle small disruptions. A bad earnings report here, a weak employment number there, but they are not designed to handle a complete data blackout during a period of maximum economic stress. It is like asking a pilot to land a jumbo jet in a thunderstorm, while someone turns off all the instruments in the cockpit. The risk parity funds are the most dangerous players in this scenario. These are massive investment vehicles, some managing over $100 billion, that automatically adjust their holdings based on market volatility. When volatility is low, they buy more stocks and bonds. When volatility spikes, they sell everything and move to cash. But here's the problem. These funds all use the same mathematical models. They all watch the same data points, and they are all programmed to react the same way when markets become unstable. When one fund starts selling, it triggers volatility. That volatility forces other funds to sell. Those sales create more volatility. More volatility triggers more selling. This is not theory. This is exactly what happened during the 1987 stock market crash, when portfolio insurance programs created a downward spiral that erased 22% of the stock market's value in a single day. The difference is that in 1987, these programs controlled about $60 billion. Today, algorithmic trading systems control over $14 trillion in assets. The Basel III regulations make the situation even more dangerous. These international banking rules require major banks to hold specific levels of high-quality capital reserves. When stock markets fall, the value of bank holdings falls. When holdings fall below required levels, banks must either raise new capital or sell assets immediately. There is no middle ground. The rules are automatic. So now the trap becomes visible. Government shutdown eliminates economic data. Missing data blinds the algorithms. Blind algorithms trigger automatic selling. Automatic selling creates a volatility. Volatility forces risk parity funds to sell more. More selling pushes banks below capital requirements. Banks must sell to meet Basel III rules, and the cycle accelerates. On the morning of January 22nd, 2026, something peculiar happened in the precious metals markets that most investors completely missed. The price of silver in New York closed at $74 per ounce. Simultaneously, in Shanghai, the exact same metal was trading at $86 per ounce. This $12 gap represented a 16% price difference for an identical commodity. In normal markets, this situation cannot exist for more than a few minutes. Traders would immediately buy silver in New York, ship it to Shanghai, and sell it for a guaranteed profit. This process, called arbitrage, usually eliminates price differences within hours. But this gap had been widening for 3 consecutive weeks. Something was preventing the normal flow of metal between markets. That something was physical delivery failure. The global silver market operates on 2 completely separate systems that most people do not understand. The first system is the paper market. Futures contracts, options, and derivatives traded on exchanges like Comex in New York and LBMA in London. This market handles billions of dollars in transactions every day. Traders buy and sell contracts representing silver, but 98% of these contracts never result in actual metal changing hands. They settle in cash. The second system is the physical market, actual bars of silver moving between vaults, refineries, and industrial users. This market operates primarily in Shanghai, Mumbai, and Singapore. When buyers in these markets purchase silver, they expect real metal delivered to real warehouses. Cash settlement is not acceptable. For decades, these 2 systems coexisted peacefully. The paper price in New York generally matched the physical price in Shanghai because enough metal moved between markets to keep them synchronized. But starting in late 2025, that synchronization began breaking down. The breakdown began with a regulatory change that almost nobody noticed. Executive Order 14346, signed in November 2025, modified how certain precious metals are classified for import and banking purposes. Buried in Annex 2 of this order was a technical exemption that reclassified monetary-grade silver bullion. This obscure regulatory change created a legal pathway for major banks to hold physical silver as Tier 1 capital under Basel III regulations. To understand why this matters, one must understand what happened to banks after the liquidity crisis began. When stock markets become unstable, banks face a mathematical problem. Basel III regulations require them to maintain specific ratios of high-quality assets on their balance sheets. Traditionally, these assets included government bonds and cash. But in 2026, both of these options became problematic. Government bonds lost value as interest rates fluctuated wildly during the shutdown crisis. Cash held in dollars faced devaluation concerns as the Federal Reserve signaled potential emergency monetary interventions. Banks needed something else, something that regulators would accept as high-quality capital, but would hold its value during a currency crisis. Physical silver suddenly became that solution. The evidence of this shift appeared in the vault data. JP Morgan's Comex silver vault inventory had grown from 87 million ounces in January 2024 to over 200 million ounces by December 2025. This accumulation happened quietly, reported in weekly updates that few analysts bothered to read. But the pattern was unmistakable. The same bank that had been accused of suppressing silver prices through massive short positions was now accumulating physical metal at unprecedented rates. JP Morgan was not alone. HSBC's London vaults showed similar accumulation patterns. Bank of China increased its physical silver reserves by 300% between 2024 and 2025. These were not speculative trades. These were strategic capital preservation moves by institutions that understood what was coming. The industrial demand side made the situation even more critical. Solar panel manufacturing requires significant silver content. approximately 20 grams per panel. The global push toward renewable energy meant solar manufacturers were consuming silver at record rates. Electric vehicle production increased silver demand by 40% year over year. Defense contractors needed silver for advanced electronics and missile guidance systems. Meanwhile, global silver mine production had peaked in 2023 and was now declining. Major mines in Mexico and Peru faced operational challenges. Environmental regulations slowed new mine development. The gap between industrial consumption and mining production was widening every quarter. But the real crisis point existed in the Comex warehouse system. As of January 20th, 2026, the Comex reported total silver inventory of 320 million ounces. This sounds like a large number until one examines the open interest, the total number of futures contracts representing claims on that silver. Open interest stood at 940 million ounces. The mathematics were simple and terrifying. If just 34% of contract holders demanded physical delivery instead of cash settlement, Comex would not have enough silver to fulfill those contracts. The exchange would face a delivery failure, a situation that had never occurred in modern commodity markets. The Shanghai premium revealed what was already happening. Sophisticated buyers in Asia understood the supply situation. They were willing to pay $12 more per ounce because they wanted guaranteed physical metal, not paper promises. They had watched the Comex inventory numbers. They had seen the accumulation patterns at Western banks. They knew the industrial demand projections, and they were buying every physical ounce they could secure before the Western markets realized what was happening. The central banks provided the final confirmation. The People's Bank of China had increased its silver reserves, separate from gold reserves, by 800% since 2023. The Reserve Bank of India launched a strategic silver acquisition program in 2024. These were not investment decisions. These were monetary policy decisions made by institutions with access to economic data that the public would not see for years. The mechanism was now clear. Western banks were converting from paper short positions to physical long positions. Eastern markets were demanding physical delivery. Industrial users were consuming supply faster than mines could produce. And the paper markets in New York and London were sitting on a mathematical impossibility. More claims on silver than silver actually existed. The liquidity freeze in equity markets would accelerate this crisis because banks would need Basel III compliant assets immediately. They would not have time to wait for mining production or gradual accumulation. They would need to acquire physical silver in days, not months. And when that buying pressure hit a market already stretched to breaking point, the price discovery mechanism would shatter completely. At 9:17 a.m. on Monday, January 26, 2026, a junior analyst at Bridgewater Associates noticed something that should not have been possible. The firm's primary risk management algorithm, a system that had been processing market data flawlessly for 8 years, had stopped updating. The screen simply displayed a blinking cursor where probability calculations should have appeared. The analyst assumed it was a software glitch. He restarted the program. The same blank screen appeared. He checked the data feeds. All connections showed green, but the algorithm refused to calculate risk because it was waiting for a specific input, the weekly unemployment claims number that the Bureau of Labor Statistics publishes every Thursday morning. Except the Bureau of Labor Statistics had stopped publishing data 3 days earlier when the government shutdown began. What happened next at Bridgewater was happening simultaneously at every major quantitative hedge fund in the world. Algorithms designed to manage hundreds of billions of dollars were encountering a scenario their programmers had never anticipated. Not bad data, but no data at all. The machines could handle corrections, revisions, even obvious errors, but a complete absence of expected inputs created something far more dangerous than incorrect calculations. It created frozen decision-making at the exact moment when decisions mattered most. By 10:30 a.m., the S&P 500 had dropped 3% on unusually heavy volume. This was not catastrophic. Markets had survived worse mornings, but the trading pattern was different. Normally, algorithmic systems would detect a 3% decline and begin calculating whether this represented a buying opportunity or a signal to reduce exposure. The calculations would factor in employment trends, inflation data, and economic growth projections. But those data points were not available. The algorithms could not determine if the decline was an overreaction to temporary political uncertainty or the beginning of a genuine economic crisis. Without data, they defaulted to their most conservative programming. Reduce risk exposure immediately. At 11:03 a.m., the first margin call hit. Millennium Management received an automated notification from their prime broker. The firm's leveraged positions had declined in value to the point where additional collateral was required within 2 hours. This was standard procedure. Margin calls happen regularly in normal markets. Millennium's traders would simply transfer some treasury bonds or cash to meet the requirement. But Millennium was already holding minimal cash reserves because of the liquidity crisis discussed in Part 1, and their treasury bond holdings had lost value as yields spiked during the government shutdown uncertainty. The firm faced an uncomfortable choice: sell equity positions at current depressed prices or deposit additional capital that would leave them vulnerable to the next margin call. They chose to sell $2 billion worth of equity positions. That selling pressure pushed the S&P 500 down another 2% by 11:47 a.m. This triggered margin calls at 6 more major hedge funds. Each firm faced the same calculation. Each firm reached the same conclusion. By 12:30 p.m., over $18 billion in forced selling had hit the market. The pension funds entered the crisis at 1:15 p.m. State pension systems are required by law to maintain specific asset allocation ratios. California Public Employees Retirement System, CalPERS, had a mandate to keep 60% of assets in equities. But as stock prices fell, that percentage was dropping toward 54%. The fund's compliance officers had no choice under their legal obligations. They had to sell bonds and buy stocks to rebalance the portfolio. Except every other major pension fund in America was receiving the same compliance alerts at the same time. They were all programmed to buy stocks during this decline. This should have stabilized the market, massive institutional buying pressure supporting prices. But there was a timing problem. Pension funds moved slowly by design. Their trading desks needed authorization from oversight committees. Those committees needed documentation justifying the purchases. That documentation required economic data showing the decline was temporary. But the economic data was not being published because of the government shutdown. The pension funds could not buy without proper documentation. So they sat on the sidelines while hedge funds continued their forced selling. By 2 p.m., the S&P 500 was down 9%, the largest single-day decline since March 2020. But 2020 had been different. In 2020, the Federal Reserve had announced unlimited quantitative easing within days. In 2026, the Fed remained silent because making policy announcements during a government shutdown created legal complications nobody wanted to navigate. The circuit breakers activated at 2:07 p.m. Trading halted for 15 minutes, as required by regulations, created after the 1987 crash. These cooling-off periods were designed to let rational thinking override panic selling. Traders would have time to reassess. Calmer heads would prevail. But the 15-minute halt changed nothing because the fundamental problem remained unsolved. Algorithms still had no data. Margin calls still required immediate cash. Pension funds still could not get documentation approval. When trading resumed at 2:22 p.m., the selling accelerated. The sovereign wealth funds provided the final catalyst at 2:48 p.m. Norway's government pension fund, the largest sovereign wealth fund in the world, held over $1 trillion in global equities. The fund's risk models showed that U.S. market volatility had exceeded acceptable parameters. Their system automatically submitted redemption orders for $40 billion in U.S. equity exposure. This was not a human decision. This was automated risk management executing exactly as programmed. The fund's managers in Oslo were probably having afternoon coffee when their system began dumping U.S. stocks. Singapore's GIC followed 7 minutes later with $22 billion in redemptions. Abu Dhabi Investment Authority triggered at 3:04 p.m. with another $18 billion. The forced selling was now coming from every direction simultaneously. Hedge funds selling to meet margin calls. Pension funds paralyzed without data. Sovereign wealth funds executing automatic risk reduction. And beneath it all, the algorithms that managed trillions in passive index funds were recalculating portfolio weights based on the new market values, which meant selling the positions that had fallen most. At 3:37 p.m., the system broke completely. A counterparty failure alert appeared on terminals across Wall Street. A mid-sized hedge fund based in Connecticut, name withheld due to legal proceedings, had failed to meet a margin call from their prime broker. The broker immediately liquidated the fund's entire portfolio. $3 billion in positions hit the market in under 6 minutes. That liquidation pushed one of the fund's largest holdings, a regional bank stock, down 41% in 4 minutes. That bank stock was used as collateral by 17 other hedge funds. Those funds suddenly faced margin calls because their collateral had lost 40% of its value. The cascade was now self-reinforcing. By market close at 4:00 p.m., the S&P 500 had fallen 14.7%, the second worst single-day performance in history. But the real crisis was not the decline. Markets had survived large declines before. The real crisis was what happened in the aftermarket. At 5:23 p.m., J.P. Morgan's commodity trading desk received an unusual alert. 17 institutional clients had submitted requests to convert their Comex silver futures contracts to physical delivery instead of cash settlement. This represented 83 million ounces of demand for actual metal. The desk checked available inventory. They had 41 million ounces in eligible warehouses. The mathematics were suddenly very simple. When twice as many people want physical metal as exists, the paper price becomes meaningless. The only relevant number is what someone will pay for guaranteed delivery of actual silver. And in a market where stocks had just collapsed, bonds were suspect, and cash was potentially worthless, that number was about to become very high indeed. The phone call came at 6:42 a.m. on Tuesday, January 27, 2026. A procurement officer at Hanwha Q Cells, one of the world's largest solar panel manufacturers, was calling their primary silver supplier in Singapore. The conversation lasted less than 90 seconds. The supplier informed them that spot delivery contracts for industrial silver were no longer available at any price. Forward contracts for April delivery were being quoted at $112 per ounce with a required deposit of 70% upfront. 3 months earlier, that same supplier had been offering immediate delivery at $68 per ounce with standard 30-day payment terms. What happened between October and January was not simply a price increase. It was the complete breakdown of the industrial supply chain that had functioned reliably for decades, and it was about to get substantially worse. The solar manufacturer was not alone in their panic. At 7:15 a.m., Samsung Electronics discovered that their contract supplier for silver bonding wire, essential for semiconductor production, had invoked a force majeure clause, claiming inability to source adequate silver inventory. At 8:03 a.m., Lockheed Martin's supply chain team learned that delivery of silver-based conductive adhesives for missile guidance systems would be delayed indefinitely. These were not financial speculators chasing profits. These were engineers trying to build actual products that required actual silver, and the physical metal had simply vanished from accessible supply chains. The mathematics behind this disappearance revealed why $500 per ounce was not sensational prediction. It was conservative calculation based on observable data. Global industrial silver consumption in 2025 totaled 894 million ounces. Mining production delivered 782 million ounces. The gap of 112 million ounces had been filled by recycled silver and inventory drawdowns from above-ground stocks. But those above-ground stocks were now being redirected. The Basel III capital reallocation, discussed in Part 2, was consuming physical inventory that would normally flow to industrial users. JP Morgan alone had removed over 100 million ounces from available supply by storing it as bank capital reserves. HSBC had done similar accumulation. Bank of China had acquired strategic reserves that would never return to the commercial market. Simultaneously, the Comex default scenario was materializing exactly as predicted. By Tuesday afternoon, requests for physical delivery had reached 217 million ounces, against total registered vault inventory of 143 million ounces. The exchange faced an impossible situation. They could not deliver metal that did not exist in their warehouses. At 2:34 p.m., Comex announced an emergency rule change. All February silver contracts would be settled in cash only. Physical delivery was suspended pending operational review of vault capacity and settlement procedures. This was unprecedented in modern commodity market history. It was an admission that the paper market had completely decoupled from physical reality. The immediate effect was predictable. Every remaining participant holding March, April, and May contracts immediately demanded early physical delivery, fearing those months would face the same forced cash settlement. The requests overwhelmed the system within hours, but the strategic implications were far more profound. Comex had been the global reference price for silver for over 50 years. Every industrial contract, every mining agreement, every financial derivative used Comex pricing as the foundation. When Comex could no longer deliver physical metal, it could no longer set the legitimate price. Price discovery shifted instantly to the physical markets in Shanghai and Singapore, where actual metal still traded, though in severely limited quantities. And in those markets, buyers were not asking what silver cost. They were asking what premium they needed to offer to secure guaranteed delivery. The premium answer on Tuesday afternoon was 38% above the now meaningless Comex paper price. The purchasing power calculation provided the clearest framework for understanding what $500 silver actually meant. This was not about silver becoming more valuable. This was about fiat currency losing credibility during a systemic liquidity crisis. The Federal Reserve's balance sheet stood at $14.3 trillion as of January 2026. The total amount of physical silver held by all ETFs, all exchanges, and all reported institutional reserves globally was approximately 2.1 billion ounces. If even 1% of the Fed's balance sheet, $143 billion, attempted to convert into physical silver at current inventory levels, the mathematical result was $68 per ounce before considering any industrial demand or Eastern market accumulation. But the actual scenario was far more aggressive than 1% conversion. The equity market collapse had destroyed $7 trillion in stock market value in a single day. Pension funds holding those equities faced massive shortfalls. Insurance companies booking those losses needed assets that regulators would accept as crisis-proof capital. Sovereign wealth funds protecting national reserves needed stores of value independent of any single government's stability. When institutional capital managing tens of trillions in assets simultaneously seeks physical refuge in a market with only 2 billion available ounces, Basic supply and demand mathematics produces extreme outcomes. The Hunt brothers crisis of 1980 provided historical precedent. Two private investors with relatively limited capital had driven silver from $6 to $50 in 18 months, simply by demanding physical delivery. But the Hunt brothers were ultimately crushed by coordinated regulatory intervention and margin requirement increases that forced them to liquidate. The 2026 situation was fundamentally different. This was not speculative manipulation. This was legitimate institutional demand driven by regulatory capital requirements and currency devaluation concerns. Central banks could not simply change the rules to stop pension funds from seeking Basel III compliant assets. Regulators could not prevent solar manufacturers from needing silver for production. The demand was structural, not speculative. The $500 calculation assumed several specific conditions. First, that 10% of institutional capital currently in equities would seek precious metal allocation, a conservative estimate given the 14% market decline. Second, that Eastern markets would continue demanding physical delivery rather than accepting paper settlements. Third, that mining production would remain constrained at current levels due to operational lead times. Under these conditions, available physical silver divided by institutional demand produced pricing between $420 and $630 per ounce, depending on the speed of capital rotation. $500 represented the midpoint of this range. For business owners and entrepreneurs, the strategic implications required clear-eyed assessment beyond emotional reactions. This was not about speculation or trying to get rich quickly. This was about understanding currency devaluation mechanics during systemic crises. When paper assets face coordinated selling pressure and physical assets face supply constraints, relative pricing adjusts violently. A business holding $10,000 in cash and 10 ounces of silver in January 2026 would face very different outcomes by March 2026 if the mathematics played out as calculated. The cash would maintain nominal value, still $10,000, but its purchasing power would depend entirely on the dollar's credibility during the crisis. The silver, however, would reprice based on physical supply-demand dynamics independent of any single currency's health. The asymmetric risk profile was stark. If the liquidity crisis resolved quickly and markets stabilized, silver might decline from current elevated levels back toward historical norms around $30 per ounce. This represented potential downside of perhaps 50% from current prices. But if the crisis accelerated as the mechanism suggested, government shutdown continuing, data blackout persisting, forced selling cascading, physical delivery failures spreading, Silver Eat's upside was mathematically unlimited because the denominator of the equation was fiat currency losing credibility. This analysis was not investment advice. It was strategic economic pattern recognition presented to serious business professionals capable of making their own informed decisions. The liquidity freeze had arrived. The margin call cascade was accelerating. The physical delivery failure was confirmed. The price discovery mechanism was breaking down. What entrepreneurs and business owners chose to do with this information in the next 72 hours would determine whether they preserved capital through the crisis or watched it evaporate in the same forced liquidation spiral that had already claimed the equity markets. The countdown was no longer theoretical. It was occurring in real time, and the window for strategic positioning was measured in hours, not days.